Welcome back to Morning Trade Live. I'm Oliver Rennick. We've got bonds. Little change this morning. The two-year yield did peak about above its range last week as we finished things off ahead of inflation this week. Let's talk bonds and more with Karen Veraa, head of U.S. fixed income strategy at iShares at BlackRock. Karen, thanks so much for being here on the Schwab Network this morning.
Happy to be here, Oliver.
Appreciate that. So this week we've got a little bit of a shift back towards the macro stuff. We've got inflation tomorrow. We do have a bunch of Fed speakers still. What's kind of your baseline here for thinking about direction of U.S. Treasury yields?
Yeah, we think U.S. Treasury yields are going to continue to be volatile this year. We're looking at the baseline for the Fed is probably going to be about 4 to 5 interest rate cuts this year, which will bring that overnight rate back down in that early 4% range. And so really the big question is where's the rest of the curve going to reshape and how quickly? So we're thinking there'll be some pressure on yields overall, but it's kind of going to be a volatile year.
Thinking about the messaging so far from the market, it's been kind of something like the opposite. It's like, hey, we don't have to worry about bond volatility anymore. Stocks have been kind of taking it all in stride. Do you feel that there is some discrepancy here then with what might actually happen? Is there a trade in here if the market has been fairly relaxed about the bond situation so far?
We're just seeing so many investors are still sitting in money market funds. They're sitting in that very front end of the curve. There's about $6 trillion sitting there. So I think a lot of investors, when they're looking at their overall asset allocation, probably should be adding a little bit more interest rate risk, a little more duration in their portfolios. So we're seeing a lot of interest right now in many of our core bond ETFs like IUSB and AGG, as well as just people using our treasury lineup to add some more intermediate exposure to their portfolios.
So the T-bill and chill, as they were calling it last year, people are still kind of stuck in there? Does it make sense to be there for longer? Or it sounds like maybe some tweaks are needed.
I think one of the hardest things is when the Fed does start to cut, those juicy yields that we're all gotten used to on the very front end are going to start to go away very quickly. So we're just encouraging people, add some duration, lock up that yield for 4 or 5 years, whether you're just stepping out of cash or using even our term maturity ETFs, our I bonds, as a way to get some yield for the next 3, 4, 5 years. So we're seeing a lot of people who are slowly getting out of T-bills, getting out of money market funds, and adding a bit more of the intermediate exposures to their portfolios.
So where then right now is kind of the least popular place to be? Because the narrative seems to be pretty clearly a matter of when, not if, the Fed cuts. As you mentioned, your guys' baseline for 4 or 5, if I heard you right, for this year. That means that we can't wait too much longer past March to start getting those cuts underway. And right now, March is in question. So where is then kind of the biggest surprise potential?
I think you're right. The start of the rate cuts are going to be the biggest impact. We're still seeing June as the most likely scenario, with them cutting 25 basis points throughout the year. So I think what could cause a differential in that is really inflation. We mentioned, as you mentioned, like we're getting that CPI print this week, and everyone's expecting it to come in really measured. But if it comes in a little bit higher, that's when the Fed might say, you know, our work is not done yet, and we need to keep rates higher for longer. So I think it's really going to be very data dependent. So let's look out for the January CPI print come out this week, because that's going to really help solidify when those cuts might come through.
Okay. The path forward seems to be that once they start cutting, they go pretty regularly. Where does the conviction come in that view after seeing Powell be pretty stop and go for the last 9 months? I mean, he was comfortable pausing on the way up and now kind of at this plateau. Why wouldn't he pause a few times on the way down?
But usually we see they want to reach that terminal rate of Fed funds in a measuredly and orderly period of time. So we did see when the previous cycle began, we did see some pausing in there on the way up. So we could get some pauses, and that's really where by the end of 2025, that rate outlook is a little less certain. So I think that's really where we're going to see probably pretty measured in 2024, but we could get some more gaps or pauses as they're fine-tuning that overnight rate come into 2025.
Okay. So then thinking about what's causing the money flows right now, if you see people shift along the duration curve, if you see people kind of tweak some of that T-bill holdings, where do they go? Give us some insight into what you guys see for flows right now across your products.
Yeah, we've seen about $8 billion coming into our iShares bond ETFs this year alone. A lot of that's either coming into some of our core exposures, whether it's IUSB, which is our universal bond ETF, or AGG, our aggregate tracker. But we're also seeing a lot of interest in our income strategies. So even though yields are a lot higher, people are saying, if I'm going to go to bonds, I really want to get paid for them. So we're seeing interest in our BlackRock Flexible Income ETF, the ticker's BINC. That fund has gathered over $1 billion in the last year. And we're continuing to see other strategies, nichier ones like our fixed income buy rights, which is a covered call strategy off of treasuries. And we've got one off of investment grade and high yield. So we're just seeing people looking for diversifying ways to add income to portfolios as well.
Let's go to the buy right strategy for a sec, because we spoke about that last summer, the summer before, I guess. It's been about almost 2 years now, coming up on in the summer. Is that becoming a way to kind of hedge a little bit, I guess? It might make sense to kind of do a covered call approach if you think that generally the baseline is a shift lower in rates from the Fed, but maybe not quite as fast as what's priced in. Would that kind of make sense in that strategy then?
Yeah, with a covered call strategy, you're giving up some of the upside to get some income today.
Yeah.
So with TLTW, which is our buy right strategy on TLT, if you think rates are going to continue to trade sideways, maybe they're not going to go down that much on the long end, this is a way to monetize that view and get some current income. So we're seeing a lot of people pairing it with some covered call strategies on the equity side to just add some more diversification.
Okay, interesting. Thinking about how this connects or competes kind of with the rest of the market, we've heard a lot of interest over the last year from kind of private credit and different approach in the alternatives category. Do you see any of that as chipping away from the case for just kind of the benchmark treasuries, or generally is this still a ballast of the overall portfolio?
Well, I think now that treasury yields are higher, when they do begin to cut, it'll actually add some ballast to portfolios. So if one of the reasons they cut, if they see a slowdown in the economy, you're now going to have some buffer and some ballast from your fixed income. You have that nice yield cushion. So I think a lot of people now, we've actually seen some more interest in high yield bonds, people wanting to come back into the riskier parts of the bond market because they are seeing such positive economic data. So we're just continuing to see people build very diversified portfolios, adding some duration, adding some high yield as a way to really balance out some of those risks and try to build some more yield into portfolios.
So the fear that the 60-40 was going to blow up a couple years ago has ebbed somewhat, people feeling a little bit more confident?
Definitely. We're seeing a lot of advisors, their 60-40s kind of got out of whack. They had too much cash. They were a little bit overweight equities. And we've seen probably the last 6 months, a lot of those moderate portfolios coming back in line with that true 60-40 allocation. Here at BlackRock, we think you should be overweight equities, but then also overweight bonds relative to cash. So as we're seeing people move their portfolios back into the right asset allocation, they really want to make sure they're not missing out on the rally, but then they have the bonds to provide that ballast in the event the rally starts to slow down, where they can add some more stability to their portfolios.
Okay. Karen, bringing a full circle here for the last point as we think about inflation this week, and a comment you made earlier about watching the shape of the curve, how that develops. 10s to 2s have basically been stuck in a range for now like 4 or 5 months. If the Fed's going to cut, as you expect, generally that leads to big bull steepening historically, but we haven't quite had that. We've kind of been stuck. So what do you see as the most likely gyration within the curve?
Yeah, I would expect those 2-year yields to start to come down when we get some clarity on the timing of the cuts. And then the 10-year yield, that's going to be a little bit volatile depending on how much supply we've gotten. Just last week, $42 billion in 10-year treasuries. It was pretty well absorbed. But if we continue to see the treasury having to print larger prints that might take a little while to get absorbed, I think we could still see some upward pressure on that 10-year yield. Okay.
Seems like then maybe last Thursday's pop in the 2-year close to 4.4 might be a dip to be bought in bonds, kind of according to this framework at this point. Karen, thanks a lot for your time. Very good stuff.
Thanks so much.
Appreciate it. Karen Veraa, head of iShares U.S. Fixed Income Strategy at BlackRock. Right, some good baseline to work off there ahead of inflation tomorrow and bonds this week.